Hello everybody, welcome to another video in my video series, The Profitable Investor. My name is Mark. This is a video series I created to help you become a better investor. And in this video, I am going to talk about how to hedge yourself, how to protect your money. Basically, how to invest in just about any stock you want, any stock that offers stock options, large cap stocks, and I pulled up Bank of America for my example here. But basically how you can invest your money and protect your money and lower your risk dramatically and still give yourself a very good, I would say even a great chance of making money. So I pulled up Bank of America. I've actually made money on this stock before using this strategy that I'm about to show you. And what it is I'm going to show you how you can buy protective puts to protect your money. And there's actually a name when you buy a stock and then you buy put options. It's called marriage. It's an option strategy, and you can look that up, Google search it if you want to learn more about it. But hopefully I do an adequate job explaining it here in this video. So let's say that you want to buy some stock in Bank of America. You really like Bank of America. You think it's going to go up, but you're not sure if there might be a recession, right? And if you're like me and you don't like losing money, then you might come up with a strategy like this to protect yourself. So first thing you would do is you would buy your stock, right? And so you click on the buy and you put in, let's say, 100 shares. And then you hit review order, and you can see the estimated total over here on the left side, $2,315. And then I'm not going to place the order, so I'm just going to close that out. But just remember, you would be investing $2,315. Now, that would be very risky if you were to just buy the shares of the stock and you think there's going to be a recession. You stand to lose most or all your money, or let's say Bank of America went bankrupt, which I don't think is going to happen. It's a very strong stock. It's $231 market cap right there. There you go, $231 billion market cap. So don't see them going bankrupt, but you never know. Let's say the worst happens and the economy tanks, etc., etc. You stand to lose $2,315. So what do? And the answer is you go to the option chain and you look at protected put options. Now, when you are investing in stock options, you can buy stock options or you can sell them. And the general rule of thumb is that when you are the buyer, you want to buy long-term stock options. And when you are the seller of stock options, you want to sell short-terms, like maybe 13 days or 41 days or maybe 69 days at the most. But since we're the buyer, we want to buy far out as we can, because the more time we have as the buyer, the better. And so here we bought Bank of America at $23.16 per share. So let's click on the $20 put, and you can see the bid is $1.90, and these are multiplied by 100, and the ask is $1.95. So let's go ahead and click on the $20 put, and we'll click the buy. Okay, and so you click the action here, and you can see there you got 4 choices. You can buy to open, buy to close, sell to open, sell to close. Well, we are the buyer, so we would buy to open our contract, and we have 100 shares, so we would buy 1 put option. Now, if we bought 200 shares, we do 2 contracts. If we bought 300 shares, we do 3 contracts. That's the idea. Every contract protects you 100 shares. And here we already got the price. It is $1.95. It will be times 100. So we'll click the review order, and you can see you will be spending $195 for that. And then you click the place order. Again, I'm not going to do that, but just know that it's $195. So your total investment when you buy Bank of America was $2,316 and that put option. Now, what is your risk and what is your reward? Well, the risk here, and this is the worst case scenario. If you were to buy that, you can see that you spent here. I'm sorry. Let me just do this. Okay. Oop, too much. Okay, there we go. You spent $195. So it's a $20 put. So you could lose all $195 in the next 650 days if Bank of America does not go below $20. If it stays above $20 and goes higher, then you will lose this $195. But that's okay, because if the stock goes up $1.95, then you start making money. So the last price was $23.16. You add $1.95. That means that if Bank of America went to $25.11, you will start making money, and that's in the next 650 days. So the question is, do you believe Bank of America will go up to $25.11 or higher in the next 650 days? Well, if I close this out and I pull up this chart, okay, we'll pull up a 1-year chart here. This is in the last year. Look at what Bank of America has done. It's been on a tear. Okay, it's literally gone up, and this stock normally doesn't move that much. If I pull up a 5-year chart, you can see normally it's a very boring, go to sleep kind of a stock. But for some reason, in this part of the year, in this last part, it has gone up like crazy. So, and now I'm going to go back to the 1-year chart so we can see easier. Okay, so you can see that at one time it was up to $24 and some change. And let's check what the 52-week high was. The 52-week high was $25.80. And so there you go. It could potentially, theoretically, go past that $25.11. And if it did that anytime, pulling up the option chain again, if it did that anytime in the next 650 days, you will begin to make money. Now, let's say in the next month, Bank of America does go up that much, and it goes past $25.11. There are different options you can do to keep your profit. You could just sell your shares and sell your put option for whatever value is left, which will you'll probably get about $100 for it, and you'll make some money on your shares, which would be $2 a share. So you make $200, and you would lose looks like about $90. So you would make about $100 there in a month, and that would be about a 5% return, right? $2,300.11, $100, that's about a 5% return. So that'd be pretty good, right? Now, if it went down, let's say Bank of America decided to go down, okay, you would lose money. And the most money you could possibly lose is if Bank of America went down to this $20 price. But it didn't go in, or lower. If it went lower, you'd still lose the same amount. So what you would lose is you would lose the $23.16 minus 20. You'd lose $316 plus the $195 you spent on your put option. So you lose $511, and that's if it did that in the next 650 days. So that would be about a 19% loss in the next 650 days, which is 20 months. So that would be an average loss of about, maybe 9%. So you're risking about 9% annual loss per year. And that's if the only thing you did was just buy the shares and bought your put option and you didn't do nothing else. Now, what you could do, since you know that your break-even price on the upside is $25.11, and if Bank of America went above $25.11, you'd start to make money. What you could do is you could sell call options. So if we go, let's say 69 days out, you look at this call option right here. You could choose this $25 call option, and it's going for 40 something cents. So let's say 40 bucks minus commission, you get 30 something bucks. Or you could do a safer one and sell this. You'd only get $22 for that. But let's say we go further out. Let's say we go out to September, 160 days. So here you go. You could sell a $26 call option, and let's say we get the bid. Let's say we get $60 minus commission. You'd make $50 in 160 days. That's about 5 months. And if Bank of America went to $26 and higher, then you would sell your shares of Bank of America at the $26 strike. Okay, so you would make, again, you would lose the money, whatever money you lost in your put option, which would probably be about 100 bucks. And then you would make this premium, and you would also make all the stock appreciation on your Bank of America, which would be almost $300 a share. And so if it went down, if Bank of America went down, then you would just make $60, and that would lower your risk. That would slowly lower your dollar cost average. So the bottom line is, I realize that I'm talking a lot and maybe I'm going a little bit fast if you don't know anything about stock options, but just know that if you want to invest your money safely in the stock market, a great way to do it is to buy shares. Let me close this out here. A great way to do it is to buy shares of whatever stock that you like, and then go to the option chain and buy a put option, the same number of put options per 100 shares. And it's just like buying life insurance. If you buy these put options, then this put option gives you the right to sell your shares of Bank of America at $20 a share. So if there is a recession and Bank of America decides to take a nosedive, then you're not going to lose that much money. You could lose the 19%, but it's better than losing, like, I'll even show you in the chart here what could happen to a stock like Bank of America, which is tied to the economy. Okay, we'll bring up the 10-year chart, and there you go. Okay, drawing the trend lines, look what happened to Bank of America during the recession. It went from $50 a share all the way down to $10 a share. Now, wouldn't it be nice had you would have bought, Bank of America up here, and then maybe you bought a put option somewhere down there, and you only lost that little bit of money, and all that money got protected right there? That's what put options do. They protect you. So look into this. It's a great strategy to buy stock and buy protected put option. It's a great way to protect your money, and it still gives you a lot of opportunity to make some money. Granted, you will not make money as quickly as you would if you didn't buy the put option and the stock went up, but the point is to protect your money and to save yourself from the next recession, whenever that is. I personally believe at some point we're going to get hit with a recession. I don't know when, but I do believe it's going to happen. It always does. That's the way our economy is structured. So I choose to do strategies like this. When I buy stocks, I'll buy protective put options. And there are some other ways that you can protect your money as well, which I may go into in other videos. Things like selling covered calls or selling credit call spreads, or you can even buy inverse ETFs. There's all sorts of ways that you can protect your money, and it's necessary to do that. You want to manage your risk. You want to protect your money. So anyways, that's it for this video. Thank you for watching, and I will see you in the next one.